This is India's #1 news network, and you're watching News9. English news as it should be.
Very good morning. You're watching News9. I'm Karthik Malhotra, and we have an exciting 1 hour packed in for you. Lots of stories from India and around the world. But the big story that we will bring to you this morning will be that is artificial intelligence emerging to be the white-collar job killer. That's the big story. We will discuss it with Prabir Jha, an HR strategist. Also on the show, we'll bring you a mood check on Indian stock markets with Avinash Gorakshakar, especially in the context of US and China getting closer to signing the trade deal. You're watching Morning Brief at 9. Watching Morning Brief at 9. Let's bring you all the top stories that we're tracking for you this morning. The United States and China reached tentative trade deal framework after London talks, paving way to ease rare earth tensions and reverse escalating export controls. Meanwhile, India and the United States conclude intensive trade talks, eye interim deal by June end and full bilateral trade agreement by the fall of this year. Switzerland projects a $100 billion investment in India over 15 years under EFTA deal, urges streamlined regulations as trade pact takes effect on October 1st. Meanwhile, India and the European Union hold strategic dialogue in Brussels, focused on defense, trade deal and joint stand against terrorism and nuclear threats. Agentic AI or AI coding agents raise job loss fears as OpenAI, Google and Meta push automation. Google CEO Sundar Pichai stays optimistic, says Google still hiring engineers. But for how long? We discuss. And back to the rare earth magnet story. Maruti Suzuki slashes E-VITARA production target amid rare earth magnet shortage as China tightens export controls. EV rollout plans take a hit. The World Bank holds India's FY26 growth at 6.3% as global GDP slows to 2.3%. Meanwhile, the state of Maharashtra has hiked liquor excise duty, aims to raise 14,000 crore rupees annually through wide-ranging changes in alcohol policy and licensing rules. Another quick commerce player, BigBasket, to now join the 10-minute food delivery race by FY26, takes on Zomato and Swiggy. Let's start with the first story that we're bringing to you this morning. After 2 days of high-stakes negotiations in London, the United States and China have reached a tentative trade framework, making a pivotal moment in easing ongoing economic tensions between the world's two largest economies. Washington and Beijing have agreed in principle on the framework for implementing the consensus reached by the two heads of state, Donald Trump and Xi Jinping, during their phone talks on June 5th. And at the separate Geneva talks held last month. Here are more details.
The US and China have struck a deal on trade at talks in London. Commerce Secretary Howard Lutnick spoke to the media in the early hours of Wednesday after 2 days of intense negotiations. He said the deal fleshed out a provisional agreement reached last month in Geneva.
So the idea is we're going to go back and speak to President Trump and make sure he approves it. They're going to go back and speak to President Xi and make sure he approves it. And if that is approved, we will then implement the framework that we have worked hard over these last 2 days.
Lutnick said the new agreement put meat on the bones of the Geneva deal that had faltered over China's curbs on the export of critical rare earth minerals. Now Lutnick says those restrictions will be removed as a fundamental part of the new framework. He said that some recent US export restrictions would also be lifted. Chinese Vice Commerce Minister Li Chenggang also spoke to reporters. He confirmed that agreement had been reached and said both sides would now report back to national leaders. Markets gave the news a cautious welcome, with Asian stocks posting modest gains in Wednesday trade. Some analysts told Reuters they were waiting to see details of the deal before making a judgment.
Seeing with trade deals being inked, India and the United States are intensifying efforts to seal a landmark bilateral trade agreement, with both sides wrapping up a week-long round of high-level talks in New Delhi. A U.S. delegation led by additional U.S. trade representatives held in-depth negotiations from June 4th to June 10th, covering a wide range of issues from market access and digital trade to customs procedures and sanitary standards that impact the farm sector. Commerce Minister Piyush Goyal said that the talks were productive and have moved both sides closer to finalizing the first tranche of a multi-sector bilateral trade agreement by fall of this year. Now, the main goal is to have a fair, balanced deal that could double trade volumes to $500 billion by the year 2030. The U.S. has temporarily suspended proposed tariffs on Indian goods until July 9th, and expectations are high that an interim deal could be sealed by the end of this month. And staying with the flavor of trade deals, on a major boost to India's economic potential, Switzerland has projected that the EFTA India Free Trade Agreement could drive $100 billion in investments into India over the next 15 years. Switzerland's State Secretary for Economic Affairs expressed strong optimism about the agreement, highlighting that Swiss companies are well equipped to deliver on this ambitious goal through quality-driven long-term investments. Now, the EFTA India Free Trade Pact, signed in March this year, will come into force on October 1st and cover Switzerland, Norway, Iceland as well as Liechtenstein. Commerce Minister Piyush Goyal confirmed that the agreement has been ratified by all 4 EFTA parliaments.
New era of partnership, of friendship, of togetherness between the 4 EFTA nations led by Switzerland, Norway, Liechtenstein and Iceland with India is going to begin in October, when the TEPA, of course, it is officially called a Trade and Economic Partnership Agreement. But as I said in the morning to our friends, the business friends from Switzerland, I look upon this as a trust and efficiency partnership agreement.
Meanwhile, India and the European Union have taken a major step forward in strengthening their strategic ties. External Affairs Minister S. Jaishankar held what he called very open and productive talks with EU High Representative Kaja Kallas in Brussels. The two sides explored closer cooperation in key areas like defense, maritime security, cyber as well as space. They also pushed forward discussions on finalizing the long-awaited free trade agreement by the end of this year. The dialogue also tackled pressing issues such as terrorism, with both sides condemning nuclear threats and agreeing on zero tolerance for terrorism of all forms. Jaishankar sharply criticized Pakistan, labeling it Terroristan. And moving on now, artificial intelligence tools like ChatGPT and Gemini are evolving fast, and now agentic tools that can perform complex tasks are raising questions about the future of white-collar jobs. Now, OpenAI and Google have launched AI coding agents that could likely replace entry-level engineers. In fact, Anthropic CEO Dario Amodei has issued a stark warning, predicting that up to 50% of entry-level white-collar jobs could disappear in the next 1 to 5 years. Now, despite this warning, Google CEO Sundar Pichai remains optimistic. Speaking with Lex Fridman, he revealed that 30% of code at Google is now AI-assisted, freeing up engineers for higher-level work. Now, Pichai also emphasized that Google still plans to hire more software engineers in the near to mid-term. Meanwhile, there are also companies like Meta and LinkedIn which are pushing AI-first hiring policies, marking a major shift in how roles are defined and filed in the age of artificial intelligence and intelligent machines. Now, some of the data seems to be quite startling, especially for those looking to start off their careers around now. Let's look at what the World Economic Forum says. Well, the World Economic Forum projects that as many as 83 million jobs could be lost globally by the year 2027, primarily affecting entry-level roles. Now, it's not just the World Economic Forum. Even Goldman Sachs has estimated that as many as 300 million full-time jobs could be affected in advanced economies. Let's look at some more data, especially that coming from Fortune 500 companies. Internship offers from these Fortune 500 companies has dropped as much as 22%. That's 1 in every 5 internships, a little over that, not being offered between the years 2022 and 2024. The internships in the technology sector, the IT sector, has declined by as much as 1/3. Now, there's also data that suggests that for every new AI job, 2 to 3 junior jobs disappear or are never posted. Well, we have a very special guest joining us this morning, Prabir Jha, distinguished HR strategist as well as founder and CEO of Prabir Jha People Advisory. Mr. Jha, good morning. Thank you for taking the time. How real is the job loss threat and how damaging do you think it will be?
Good morning, Karthik. Always a pleasure. And no, it is a scare for sure. It's a very serious scare because you've shared some bit of the data already. And the fact is the trend is going to be secular. It will continue to kind of intensify. What the numbers would be, we don't know yet. At least I don't know. Because it could intensify, it could possibly take a different shape. But the fact that the entire arena of work across sectors and industries is getting reshaped is a given. The fact that many jobs which were hitherto just routine engineering jobs, whether it was in software or otherwise, that is going to get impacted. But I would tend to agree more with what you shared from Sundar's perspective. Mm-hmm. The trend of decline is clear. Right. But does it mean that all jobs or all internships are going to disappear? Not likely. But it will definitely see a major reinvention. So all that right. is a scare for sure.
Right. So, of course, major reinvention, I think, is not something that a lot of job seekers out there would be fearful of. In fact, they may want to get trained on AI to be able to use it better. But it seems that the immediate threat, Mr. Jha, comes only for entry-level employees. At this level, is it safer to assume in that sense that senior level jobs are going to be a little easier to protect, if I can put it that way, at least for now, because that is where decision making and experience comes in, and that is something that AI, at least in the immediate future, may not really be able to replace.
I agree with you, Karthik. The middle and the entry level jobs are going to be most vulnerable. In fact, middle I will be even more worried about. Because entry, you can rethink your start strategy, you can rethink your industry strategy or career strategy and all that. Middle is you're already on the boat in the middle of the sea. Right. What do you do? So I think senior level jobs, because of some strategic perspective, the ability to still integrate, the ability to still think differently, and the fact that senior level jobs relatively are lesser in numbers than middle and junior level jobs, are likely to see a little bit more of protection. It's not that everyone is safe, but entry jobs, definitely that's, a block that I see happening. But I'm particularly worried about middle level jobs, because if people do not reinvent themselves and reinvent very fast, learn a different thing, I really worry many of them are not likely to have jobs a year, 2 years from now.
Oh my God, Mr. Jha, you're scaring me this morning. I happen to be in that bracket. Well, I was just losing hair until now. I think I'm going to start losing some sleep as well. But I want to understand now from you the larger impact of these job losses on economies. Now, there are going to be no jobs. That means there are going to be no consumption, fewer tax collection, lesser tax collection for governments. How are economies going to work if jobs become harder to come by and employees find it harder to hold on to their jobs? Where are the taxes going to come from, and where is the consumption going to come from?
So one is, the direct tax versus the indirect tax approach. I overall think economies will still do better. Okay. Companies which are able to reimagine and reinvent themselves are definitely going to have, cost edge. They will do better, and therefore the tax collection will come. It's almost like what we see in India. Mm-hmm. The direct taxes, the GST equivalent, that is increasingly becoming the bigger pie, and you are actually able to reduce the contribution of direct taxes.
So, sir, sorry to cut you in here, but even for indirect taxes, for let's say GST to be collected, you need consumption to happen in the economy, and that consumption is directly linked to what people are making as income. So if entry-level jobs don't find incomes because those jobs are going to cease to exist, and middle-level folks find it hard to hold on to their jobs, then how will consumption take place in the economy?
No, you're right. I don't have an immediate answer of how it will pan out. It is a threat. But my own take is that, the consumption pattern is going to get a lot more differentiated.
Okay.
That is one. I think there are going to be many people who will have actually more surplus in their hands, because that is what I find in the talent approach. It will get more differentiated. I also think that, it is not going to be necessarily AI impacted jobs, but if people are willing to kind of do jobs different than what they had so-called studied for, or they had mentally aspired for, it is not jobs are going to go away. A lot of front-end jobs are going to still become and stay very relevant. A lot of jobs which actually, need creativity, need the human touch. I think what, Karthik, I personally think is that it's a good time for students, for parents, for academic institutions to actually make that shift from a class of jobs, which for some decades has been the principal by default focus, and start the jobs which are going to be still relevant. And this is, again, back to my thesis, it's a mindset shift. For example, geriatric support will become very important, more so from an Indian perspective. Healthcare, will become very important, because, at the end of the day, there will be people who will be falling ill, there'll be money to be made. Now, you may not have thought about healthcare, you may not have thought about getting in this service support areas, but you might just want to still have just some kind of an engineering degree. I think some of that will get to be called to question. I'll give you one little anecdote just to drive home the point about, 25, 26 years ago, I remember that I was battling a situation when CAD/CAM was coming in.
All right.
Until that time, draftsmen were people who would physically draw out, using their instruments and on paper and stuff like that.
That's right.
I can tell you 80% of the so-called draftsman team, we had to let go. And it was very painful, because 20% were willing to learn the new skill of CAD/CAM, which is not rocket science. It's almost AI is going to make it very intuitive. But the mindset is such that, no, I can't do it. I've never done it. And this is what I would suggest to youngsters thinking about career choices. Please read the writing on the wall, think different, and just do not do what, maybe a generation before you blindly did. And this is a big societal challenge for India, given the hype that has historically been created.
That's right. So what I'm hearing from you, Mr. Jha, is that disruption is definitely coming. It's coming fast. You can either opt for fields where perhaps AI is not going to cause as much disruption. But if you do opt for fields which are getting disrupted, then it's important to upskill and be open and adaptable to this changing rate of technology and adopt these technologies. So my final question to you, Mr. Jha, is that whose responsibility is it for this upskilling to happen? Would it be the responsibility of the governments? For example, the United Arab Emirates has introduced AI in school curriculum. Or would it be the responsibility of CEOs to make sure that their employees are upskilled? Would it be HR professionals, HR functions like the ones that you have led? Or does the buck stop with employees themselves to, like you said, read the writing on the wall and upskill to save yourself?
I think the responsibility is with everyone, starting from the individual and the society. In India, the societal reconditioning is very, very important. We are still thinking very, very typically, and that is not what's going to work. The government will, of course, have to enable it. I think the academic institutions will have to rewire a lot of the curriculum from school through college to whatever else. I think companies, CEOs, CHROs, they'll all have to kind of think differently. See, the basic thesis is AI is not going to replace all humans everywhere. That's not going to happen. But humans with AI or with awareness and the willingness to leverage AI will surely replace humans without the willingness to leverage artificial intelligence. I think If you look at it very closely, this is going to be the problem because AI is going to make a lot of work fairly intuitive. Are you willing to leverage it? Are you willing to learn? We are not saying everyone has to be an AI technologist. That's not your job. But are you willing to leverage? And at the end of the day, in a country like India, where even a rickshaw wala or a sabzi wala is very comfortable doing his transactions on UPI on a mobile, I see that as a ray of hope. But the question is, the minute you kind of put it in the context of employment, people still continue to think historically. And that is something which has to change. So whether you're an entry-level guy, whether you're in school, whether you're in the middle segments, or for that matter, you're at senior levels, the invitation is, are you willing to change, and are you willing to change at speed and scale? That, I think, is where the government, the academia, the companies, and the society stroke individuals will all have to come together. And that is the big challenge.
All right. Well, willingness to change and change at scale. That's the word coming in. Mr. Prabir Jha, always a pleasure having you here on News9. Thank you so much for your time today. And with that, we will slip into a short break. The Indian stock markets have just opened, flattish open, albeit a little bit in the green this morning. We'll have Avinash Gorakshakar to help us decode what the trading strategy for the day should be. You're watching Morning Brief at 9.
Your walls are just OMG. Which paint?
नया बिरला ओपस
जो पहले से चल रहा है वही लगाना था ना।
नया बिरला ओपस पेंट्स फर्नीचर मार्क से बचाता है। सी
जो पहले से चल रहा है वही।
इनको जमाने से पीछे चलने दो। आप चुनो नया बिरला ओपस पेंट्स।
This is the drive of your dreams. Introducing the all-new Skoda Kailak. Own your dream.
Skoda.
A deep dive into what matters to you the most. Angles you won't find anywhere else. News that impacts your life.
Welcome back. You're watching Morning Brief at 9. Let's bring you a mood check of the Indian stock markets as they opened in the bourses just a few minutes ago, where it seems to be a slightly positive open for markets this morning, but much of it remains to be flat. Not really a major fillip that one could have otherwise expected after the tentative trade deal between US and China, which pushed the US markets up. Sensex and Nifty are both up this morning, but just about 0.1% or so on the index. Remember, yesterday the Indian stock markets had snapped their 4-day winning streak and ended a little bit in the red. Sensex this morning below the 82,500 mark. Nifty just about holding on to the 25,126 odd level. So that's the news coming in from the main indices. But the action on the small cap and the mid cap space seems to be a little more positive this morning. The Nifty small cap 100 is up about 0.4 percentage point. The mid cap is about a third or so up in trade this morning. But the view on the Nifty 50 heat map seems to be a little confusing. There's a mix of red and green. The red seems to be really dominating the heat map this morning, but where it's green, it's nice and shining. Reliance Industries, for example, is up almost a percentage or so in trade. ONGC is up about 0.6%. The mixed bag that we're seeing from the IT sector seems confusing. TCS, Wipro, Tech Mahindra all in the red, but Infosys and HCL holding fort and appearing a little bit in the green this morning. Similarly, the auto stocks are doing well. Maruti stock opened a little weaker, but has picked up momentum since then, and perhaps it opened weaker on cues of the company cutting the production of E-VITARAs. Of course, we will bring you that story as well, but we have a special guest joining on this morning. We have Avinash Gorakshakar, Head of Research at Profit Mart Securities. Mr. Gorakshakar, good morning. Thank you so much for being here with us. Help us understand, what is the mood of the market today? Are we in a consolidation space? Is this just a little bit of buying that we are seeing because markets ended a little lower yesterday? What's going on in the Indian stock markets?
No, I think good morning, Karthik. I think markets are going to consolidate. I think clearly, I think the markets have seen a very strong runaway rally. And I think largely aided by, liquidity, both from the domestic as well as the FIs. And most importantly, I think global tailwinds are now shaping up well. As you rightly pointed out, the mood in the market is that trade deals are going to be announced with India also in a very short period of time. India has already entered into a trade deal with 4 European countries, and that I think was a big sentimental booster. Plus, the rate cut which came this time, Karthik, was a big surprise. I think a 50 basis point cut is going to actually make banks as well as NBFCs look more interesting now in the coming quarters. And for the corporate earnings as a whole, I would say that rate sensitive sectors like automobiles, real estate, capital goods, manufacturing, construction companies, these are the pockets where I think you're going to see a lot of improvements in the quarterly numbers, specifically for the July to September quarter. So I think all said and done, I think, once the monsoon progress is known in the next couple of months, I think the markets would start taking this positively, and we could see a reasonably good trajectory, from September. I think globally, sectors like, pharmaceuticals, IT, they would continue to move up once the trade deal with the US is announced. And I think some clarity comes on the tariff measures. So I think net, it's a buy on decline market. Today, market may open flattish, considering the fact that now 25,000, we've reached this level. But to cross it consistently, I think you'll require a few more triggers, going forward.
All right, few more triggers. But let's talk about one of the triggers that you spoke about, and that is the RBI rate cut bonanza that we saw. But banking stocks that I'm seeing this morning, and again, that has been the trend yesterday and today as well. The banking stock seems to be, not really reacting very well to that rate cut, simply because their net interest margins are likely to come under pressure. That doesn't seem to be the case with NBFCs, which don't have to immediately pass on the benefits of the rate cut. But again, from a pure play RBI decision to cut 50 basis points, given what we are seeing with China, with this fear of inflation likely to creep in, at least for white goods and the auto sector, with the export curbs on rare earth magnets, do you think the RBI hurried into that 50 basis point cut, or do you think the timing was quite perfect?
No, I think first of all, I think RBI wanted to give growth a bigger fillip, and I think to that extent they have taken a calculated risk. I believe that near-term headwinds for inflation may be there, but in the medium to long term, I think most of the public sector banks, private sector banks are going to cut down interest rates, and that is definitely going to be a big booster shot for interest sensitive sectors. So I think net, we'll have to wait for maybe a couple of months to see how the rate cuts happen, how the benefit of these interest rates cutting is going to help these companies. But my sense is the July to September quarter is going to be a much better and a significantly better quarter, which would get reflected into better earnings numbers. Because clearly, I think wherever the interest sensitive rates are there, especially if you talk about real estate companies, automobile companies, they would definitely benefit. And yes, as you rightly pointed out, Karthik, the rare earth problem is going to continue for a couple of months before some final solution is arrived at. As of now, we have heard many companies cutting back production because this is a very critical input for electric vehicles. So I think we'll have to wait and watch, but I think some solution will definitely come in. I don't think the government would like the EV industry to come to a complete standstill.
Right. But The fear of inflation, do you think that is real, especially when it comes to white goods and automobile sector, at least in the near term, because any sort of truce between India and China could also take a little longer, and auto companies already cutting back production. That seems to be some sort of a sign where inflation could perhaps creep back in, and then it'll be difficult for the central bank to hike interest rates.
Yeah, I think, basically, there's definitely the possibility of interest rates moving up, especially looking at auto and white goods, looks a very strong near-term possibility. But I think we'll have to wait and watch for a couple of months, because as of now, most of these auto companies have got enough inventories of this critical raw material. But in case they stop production and, prices go up, there are some shortages, then that could possibly spike up inflation. And that point of time, RBI could face a big challenge. But I think, for these things to happen and fructify, we'll have to wait for a couple of months. I'm quite positive that inflation will be within control, but, challenges obviously continue to remain.
All right. Finally, I want to draw your attention to the energy stocks this morning. And again, after we saw that some sort of a tentative trade deal struck between US and China, the oil markets are responding positively. We see Reliance is up about 1.3% in trade. ONGC is up about 1.1%. So is the case with Coal India. Now, these seem to be really taking the benchmark indices higher this morning, because all other sectors seem to be reacting in a mixed manner. So from here, how does the oil story, the crude oil prices and the WTI prices, given the fact that China and US are more likely to work closer together in the future, how does the oil story pan out from here, Avinash?
No, I think my guess is that at least in the very near term, I don't think there could be any major spike on the crude oil price front, although yesterday we saw a little bit of upside there. See, my sense is that it all depends on the demand-supply scenario. China has been a big buyer, but then of late, their buying has reduced, and India is a very big buyer of oil in the global market. And looking at OPEC and the kind of supply logistics which they have, initiated, I think at least for the next 2 to 3 months, Karthik, our sense is that crude price will remain in a close range. Okay. Thereafter, of course, we'll have to see what kind of developments happen, what is the kind of oil demand expected from China. But overall, I believe that, this year crude may not give you a bigger kind of a negative surprise. Okay. But post-September, we'll have to take a fresh review.
All right. So everything now hinges on the next quarter in September. And by the end of September is when we are likely to see some more action and some more definitive trajectory for the markets. Avinash Gorakshakar, thank you so much for your input and for joining us here on News9 this morning. Well, coming to the story we were just discussing, India's largest car maker Maruti Suzuki is scaling back production plans for its much-awaited electric SUV, the E-VITARA, due to, of course, the shortage of rare earth magnets from China. Now, industry sources say the company will produce just 8,000 units of the E-VITARA by the month of September, a sharp cut from its earlier target of over 26,000 units. Now, while Maruti Suzuki plans to make up for the shortfall later in the year, aiming for 67,000 units this fiscal, the impact of China's export restrictions is being felt across the auto sector. Now, even though Maruti's chairman recently claimed production hasn't been affected yet, the industry is seeking government help to speed up approvals from Chinese authorities to import these critical rare earth magnets. Now, remember, since April this year, China, which controls over 90% of global rare earth magnet processing, has imposed stricter licensing rules for exports of key materials like samarium and dysprosium used in EV motors and braking systems. So, well, we will now do a deep dive into just how devastating will the impact of magnet shortage be, and how is India really preparing for this eventuality? My colleague Shweta Kothari explains.
India's race to secure critical minerals is picking urgency, but there is a crying need for speed, with China now imposing fresh export curbs on rare earth elements, especially magnets. India's industrial ambitions are under threat. Now, these curbs, described by Commerce and Industry Minister Piyush Goyal as a wake-up call for the whole world, must sharpen New Delhi's focus on long-standing overdue mining reforms. Now, rare earth elements like neodymium and dysprosium are indispensable in making high-performance magnets, which are used in electric vehicles, wind turbine, defense electronics, and even consumer white goods like refrigerators. A single EV requires nearly 2 kilograms of these magnets, while India's white goods sector relies on them for compressors, fans and sensors. Now, Goyal, speaking in Switzerland, highlighted how India is actively building alternative supply chains and treating this disruption as both a crisis and an opportunity. He confirmed that the Indian embassy in Beijing is in touch with Chinese authorities to resume stalled shipments. Simultaneously, the government is also boosting domestic production through Indian Rare Earths Limited and also exploring other global magnet sources. This supply chain crisis situation is similar to the 2021 semiconductor shortage, when China's post-zero COVID exports controls triggered price spikes in automobiles as well as electronics worldwide. Now, will EVs, electronics and home appliances see inflationary pressure once again? If rare earth access remains choked, that's something that policymakers should guard against, especially as inflation has finally come under control and the central bank RBI has doled out a handsome rate cut. Back to magnets. India has 6% of world's rare earth reserves but contributes less than 2% to global supply. The mining sector remains engulfed in regulatory bottlenecks, slow exploration and limited private sector participation. Reforms ranging from policy overhauls to magnet manufacturing incentives, perhaps in the form of a PLI, may be underway. But Minister Goyal has cautioned results will take time. As China weaponizes its mineral dominance, India's path forward lies in speed, scale and self-reliance. The clock is ticking, not just for policy, but for industrial self-reliance.
The World Bank has retained India's economic growth forecast at 6.3% for 25-26 this financial year, highlighting growing global uncertainty and trade tensions as major challenges for most economies. Now, this comes after the World Bank had trimmed its January projections of 6.7% for India earlier in the month of April. In its latest Global Economic Prospects report, the World Bank warned that global GDP growth will likely slow to just 2.3% this year, the weakest pace since the 2008 economic crisis, excluding recessions driven by rising tariffs, especially in the United States. The Reserve Bank of India has also retained its FY26 forecast, but higher than World Bank at 6.5%, but flagged caution amid global trade patterns and looming risks from US tariff policies under US President Donald Trump. Well, moving to a state story now, the Maharashtra cabinet has approved a major hike in liquor excise duties, aiming to generate as much as 14,000 crore rupees in additional annual revenue. Now, under the new policy, Indian-made foreign liquor or IMFL category will now be taxed up to 4.5 times the declared manufacturing cost, a big leap from the earlier 3x cap. Country liquor too sees a hike, with duties rising from 180 rupees to 205 rupees per proof litre. Now, the state is also tightening enforcement, approving over 1,200 new posts in the excise department. Meanwhile, FL2 and FL3 license holders will now pay an extra 10 to 15% in annual fees if they opt for conducting agreements. We'll slip into a short break, but before that, a quick look at the other global stories that we're tracking for you today. After 2 intense days of negotiations in London, United States and China reach a tentative trade framework. Commerce Secretary Howard Lutnick voices optimism, but the deal still needs nod from leaders in Washington and Beijing. US stocks rise as optimism grows around the US-China trade talks. The S&P 500 inches closer to record highs, with investors now eyeing key inflation data due later today. US court rules in favor of President Donald Trump allows his sweeping Liberation Day tariffs to remain in place for now. Meanwhile, Trump says he's ready to invoke the Insurrection Act over protests in Los Angeles, calls for unrest, a national security threat. California Governor Gavin Newsom blasts Donald Trump's decision to send U.S. troops to LA, calls it reckless move that only fueled tensions. The European Commission rolls out 18 sanctions package targeting Russia's energy, banking and defense sectors. Ukraine's President Zelensky welcomes the new EU sanctions but says the oil price cap should be slashed further down to $30 a barrel for Moscow. Meanwhile, artificial intelligence powerhouse OpenAI reports its revenue rate at $10 billion, driven by explosive demand for tools like ChatGPT. Marks & Spencer is back online for clothing orders after a 46-day shutdown caused by a cyber attack. The British retailer warns the incident could cost it over $400 million. All these stories on the other side of the break. You're watching Morning Brief at 9. Welcome back. You're watching News 9. Let's bring you all the global stories that we're following for you this morning. A major legal win for US President Donald Trump as a federal appeals court ruled on Tuesday that Trump's sweeping Liberation Day tariffs can stay in place, at least for now. The US Court of Appeals for the Federal Circuit in Washington, D.C. paused a lower court decision that found Trump overstepping his authority in imposing the trade measures. Now, the tariffs, which target imports from key partners like Canada, China and Mexico, were enacted under an emergency economic powers law, a justification still under judicial review. Now, despite the unresolved issue, the court is allowing the tariffs to be enforced while the case continues. Business and markets, already rattled by the unpredictable nature of Trump's trade moves, now face continued uncertainty. Now remember, this ruling does not touch tariffs imposed under traditional trade authorities like those on steel and aluminium. Meanwhile, US President Donald Trump on Tuesday said he would invoke the Insurrection Act if he deemed the ongoing immigration protests in Los Angeles to be part of a wider insurrection. Now, his remarks came amid mounting unrest in the city, prompting a nighttime curfew as local authorities sought to calm tensions on the ground. Now, despite repeated assurances from local law enforcement that they were capable of managing the situation, Trump escalated the federal response, ordering 4,000 National Guard troops and 700 active duty Marines to Los Angeles. The president claimed the move was necessary to take back control, even calling the protest an invasion by foreign enemy. Now, later in the day, Trump visited a military base to mark the U.S. Army's 250th birthday, but the appearance quickly took on a campaign rally tone. Surrounded by soldiers, the president used the occasion to double down on his political stance. Let's listen in.
Before going further, I want to say a few words about the situation in Los Angeles, California. Have you heard of the place? Where I've deployed thousands of National Guard troops and hundreds of Marines to protect federal law enforcement from the attacks of a vicious and violent mob. And some of the radical left, they say, oh, that's not nice. Well, if we didn't do it, there wouldn't be a Los Angeles. It would be burning today, just like their houses were burning a number of months ago. Generations of Army heroes did not shed their blood on distant shores only to watch our country be destroyed by invasion and third world lawlessness here at home, like is happening in California. As Commander-in-Chief, I will not let that happen. It's never going to happen. What you're witnessing in California is a full-blown assault on peace, on public order, and on national sovereignty carried out by rioters bearing foreign flags with the aim of continuing a foreign invasion of our country. We're not going to let that happen.
And staying with that story, U.S. Defense Secretary Pete Hegseth said on Tuesday that the deployment of National Guard troops and Marines to Los Angeles is specifically intended to protect federal immigration officers. Hegseth pointed to recent violent clashes sparked by ICE operations targeting alleged immigration offenders as the driving force behind the move.
So in Los Angeles, we believe that ICE, which is a federal law enforcement agency, has the right to safely conduct operations in any state and any jurisdiction in the country, especially after 21 million illegals have crossed our border under the previous administration. ICE ought to be able to do its job, whether it's Minneapolis or Los Angeles. You asked about the situation in Los Angeles, and we believe ICE agents should be allowed to be safe in doing their operations, and we have deployed National Guard and the Marines to protect them in the execution of their duties, because we ought to be able to enforce immigration law in this country, unlike what Governor Walz did in 2020.
Well, staying with the U.S. stocks made gains on Tuesday as investors bet on positive results from the U.S.-China trade talks aimed at diffusing the tariff dispute that has roiled global markets this year. The S&P 500 is now trading just below its February record high as investors await consumer price data due on Wednesday. Take a look.
U.S. stocks ended higher on Tuesday as investors bet on positive results out of trade talks between the U.S. and China. The Dow rose 0.25%, the S&P 500 added 0.5%, and the Nasdaq climbed about 0.6%. The trade talks in London are aimed at diffusing a tariff dispute that has roiled global markets this year. U.S. Commerce Secretary Howard Lutnick said earlier on Tuesday that the trade talks were going well and could run into Wednesday. Later, U.S. Treasury Secretary Scott Bessent told reporters the talks would continue as needed.
We have had 2 days of the productive talks. They are ongoing. My colleagues, Secretary Lutnick and Ambassador Greer, are going to be continuing as needed with the Chinese delegation. So thank you very much.
Are we going to have a deal tonight?
With investors betting the U.S. will reach trade agreements that reduce Trump's steep trade barriers, the S&P 500 is now trading just below its February record highs. Michael Landsberg, Chief Investment Officer with Landsberg Bennett Private Wealth Management, says companies continue to perform well despite the tariff concerns.
The market's had good earnings. We've had, basically the S&P 500 last quarter was up 12% year over year. NASDAQ up 23%. I think people have realized that, a lot of the death of the market has been greatly exaggerated. Tariff talk has basically sucked the air out of every room you go into. It's all everybody talks about. I think people missed a lot of the fundamentals that we had in the quarter, which is basically, again, stronger earnings, double digits, and all the major indices, even the Russell 2000, which we don't like, had double-digit earnings growth year over year.
Stocks on the move Tuesday included J.M. Smucker, which plunged 15.5% after the Jif peanut butter maker forecast annual profit below estimates. And shares of Snap bounced between gains and losses after the social media platform said it would launch its first ever smart glasses for all consumers next year, ratcheting up competition with Meta in the wearable tech market. On Wednesday, investors will weigh consumer price data from the Labor Department, which could show the impact of U.S. tariffs on goods prices and could influence the path the Federal Reserve takes on interest rates.
Moving on now, the European Commission is ramping up pressure on Moscow, unveiling an 18th round of sanctions in response to Russia's invasion of Ukraine. On Tuesday, Commission President Ursula von der Leyen said the fresh measures target Russia's energy earnings, banking sector and military industry. Brussels is also pushing the Group of 7 or G7 countries to slash the price cap on Russian crude oil from $60 a barrel to $45 a barrel in a bid to further squeeze the Kremlin's energy revenues.
It is to impose the rule of might. Therefore, we are ramping up pressure on Russia because strength is the only language that Russia will understand. Therefore, we are now proposing an 18th package of hard-biting sanctions. We're targeting basically two sectors, the Russian energy sector and the Russian banking sector. We're widening export bans and controls, and we strengthen the anti-circumvention measures. For the first time, we propose a transaction ban for Nord Stream 1 and Nord Stream 2. This means that no EU operator will be able to engage directly or indirectly in any transaction regarding the Nord Stream pipelines. There is no return to the past. We also propose to lower the oil price cap from $60 to $45 per barrel.
Artificial intelligence giant OpenAI said on Monday that its annualized revenue run rate surged to $10 billion as of June, positioning the company to hit its full-year target amid booming AI adoption. The ChatGPT maker said the revenue figures exclude large one-time deals and licensing payments by major backer Microsoft. Take a look at this report.
Business is booming at OpenAI. The ChatGPT maker said Monday that revenue had hit an annual rate of $10 billion as of June. That excludes large one-time deals and licensing payments by major backer Microsoft. Overall, it leaves OpenAI well on track to hit a target of $12.7 billion in revenue for 2025. That suggests it's far ahead of competitors in generating money, though they too are seeing gains. Rival Anthropic recently surpassed $3 billion in annualized revenue. But the pace of change is striking at OpenAI, which lost about $5 billion last year, and that's helping drive lofty valuations for the firm. In March, it said it would raise $40 billion in a new fundraising round led by Japanese investor SoftBank. The deal valued OpenAI at $300 billion. Since launching ChatGPT in late 2022, the outfit led by Sam Altman has rolled out a bevy of subscription offerings. By the end of March, it claimed to have 500 million weekly active users.
British retailer Marks & Spencer resumed taking online orders for selected clothing lines on Tuesday after a 46-day hiatus following a damaging cyber attack. The 141-year-old Marks & Spencer predicted the attack would cost it about $404 million in operating loss. Take a look.
British retailer Marks & Spencer is back online. It resumed taking orders for some clothing lines on Tuesday. That's after a 46-day hiatus following a damaging cyber attack. 141-year-old M&S is one of the best-known names in British business. It was forced to stop taking clothing and home orders through its website and app on April the 25th. It first disclosed it had been managing a cyber incident a few days before. M&S said last month it expected online disruption to continue into July and forecast the attack would cost it about $404 million in lost operating profit, though it hopes to halve the impact through insurance and cost control. The group said hackers broke into its systems by tricking employees at a third-party contractor, skirting its digital defences to launch the cyber attack.
And finally, a human-sized Labubu figurine fetched over $150,000 at a Beijing auction house on Tuesday, setting a new record for the popular blind box toy. The sale marks the toy's leap from pop culture craze to high-end collectible. Take a look.
报价7500，在现场报价4000、5000、22000，在网络价格1万。
It sold for 1.08 million yuan, which I believe is a record. Definitely a world record for a Labubu sculpture. But I think the price will go even higher in the future. Because it's truly a non-standard art piece. Collectors would have thought long and hard before offering such a price for this work of art.
I think pop art has been around for quite a long time and it has developing new products.
And that's all we have for you on the show today. But of course, news continues right here on News 9 on the other side of the break. So stay tuned.
Is life transactional by any chance? Everything in the creation affects everything else. I think the existential question that all of us grapple with, that who am I? From being somebody to becoming nobody is the first step in enlightenment.
Watch Duologue with Barun Das at these times on News 9.
He plainly tried to internationalize the Kashmir issue.
We know as a matter of fact that it was Pakistan that ran to America.
West seems to disregard anything that doesn't affect it directly.
Donald Trump is trying to tell the world that I am the savior. He has no business of speaking about Kashmir.